Are you unknowingly making investment mistakes that are costing you thousands of dollars? It's easy to fall into certain traps while investing, especially with so many factors at play in the market. What you might not realize is that these seemingly small mistakes can have a huge impact on your returns over time. From holding too much cash to chasing trends and failing to account for taxes and inflation, these errors can make or break your financial future. In today's video, we'll walk through 8 common investment mistakes and show you how to avoid them, ensuring you keep more of your hard-earned money in your pocket. 1. The cash drag delusion. Holding too much cash while waiting for a market crash often costs you more than the crash itself. This is a mistake that many investors make, thinking they'll wait for the market to drop before they invest. The problem is that by holding on to cash, you're missing out on the potential gains of the market. Historically, some of the best market returns happen during periods of sudden recovery, often right after a significant drop. Missing even just a handful of the best trading days over the course of a decade can dramatically reduce your total returns. In fact, missing the 10 best trading days can literally cut your overall investment returns in half. If you're holding on to cash in anticipation of a crash, you may find yourself on the sidelines when the market bounces back, leaving you with fewer gains than if you had invested in the first place. 2. High expense ratio blindness. Many investors overlook the expense ratios of their investments, assuming that a small fee doesn't matter much. However, these fees can have a massive impact on your returns over the long term. A 1% or 2% fee might not sound like a lot, but over 30 years, those fees can add up to a significant amount, sometimes swallowing up to 40% of your total portfolio value. When you invest in mutual funds or exchange-traded funds, ETFs, the management fees are often listed as an expense ratio. This is the annual fee charged by the fund manager to cover the fund's operating costs. While these fees are usually small, they can eat away at your returns over time, especially if you're investing large sums of money. That 1% fee could cost you thousands of dollars over several decades, reducing your overall return. The good news is that it's easy to check the expense ratio of your investments and make changes to lower these costs. To avoid this mistake, make sure to compare expense ratios before investing in any fund. Opt for low-cost index funds or ETFs that track broad market indices. These funds typically have much lower fees, allowing you to keep more of your money in your portfolio. By keeping an eye on these fees, you can save thousands and improve your investment returns over time. 3. Lifestyle creep in your portfolio. As your income grows, you might be tempted to increase your spending on non-essential items. This is known as lifestyle creep. Many investors make the mistake of spending more as they earn more, rather than using that extra income to contribute to their investments. This can prevent you from reaching the critical mass in your portfolio, where your interest starts earning more than your labor. When you receive a raise or bonus, it's easy to justify upgrading your lifestyle with bigger expenses, like a fancier car, a larger house, or more frequent vacations. While treating yourself is important, neglecting to invest that extra income can prevent you from building wealth over time. By increasing your investment contributions as your income rises, you can accelerate your financial growth and eventually see your portfolio earnings outpace your salary. Set up automatic contributions to your retirement or investment accounts so that the increase in your income directly flows into your investments. This will ensure that your growing income works for you and helps you achieve your long-term financial goals. 4. Diversification. It's commonly believed that the more diversified your portfolio is, the less risk you're taking. While diversification is key to managing risk, over-diversification, also known as diversification, can actually harm your returns. This happens when you spread your investments across so many assets that they become redundant, lowering your overall potential for growth. For example, owning 50 different mutual funds that all hold the same top 10 tech stocks doesn't really diversify your portfolio. Instead of reducing risk, it simply multiplies your fees. True diversification means holding a mix of uncorrelated assets, such as stocks, bonds, real estate, and commodities, that respond differently to market movements. This approach reduces risk while still offering potential for solid returns. To avoid diversification, focus on building a portfolio with a variety of asset classes that are not closely correlated. This will provide the protection you need in down markets, while still allowing your portfolio to grow during upswings. Too much of the same thing in your portfolio can lead to unnecessary costs without providing any added benefit. 5. Ignoring the tax drag. Many investors fail to account for taxes when making investment decisions, which can result in substantial losses over time. When you trade frequently in a standard brokerage account, your profits are subject to short-term capital gains taxes, which are taxed at your regular income rate, anywhere from 20% to 37%, depending on your income. This can take a significant chunk out of your returns, especially if you're actively trading. To avoid the tax drag, consider moving your active trades to tax-advantaged accounts like a Roth IRA or a 401k. By doing this, you can defer taxes on your gains or even eliminate them altogether in the case of a Roth IRA. This strategy allows you to keep more of your returns, increasing your overall wealth. Make sure to account for taxes when planning your investment strategy and take advantage of tax-deferred or tax-free accounts when possible. 6. Recency bias and trend chasing. One of the most dangerous mistakes investors can make is falling victim to recency bias, investing in assets based on their recent performance without considering the long-term outlook. For instance, chasing trends like a hot stock, cryptocurrency, or technology might seem tempting after a strong performance, but by the time the trend becomes mainstream, the massive gains have already been priced in. Investing in what did well last year is like driving through a rear-view mirror. It's reactive instead of proactive. Rather than chasing trends, focus on solid long-term investments with a strong track record and potential for continued growth. Stick to your investment strategy, avoid chasing the latest hype, and invest with a long-term perspective to avoid costly mistakes. 7. The sunk cost trap in single stocks. One of the most emotionally challenging mistakes to avoid is the sunk cost trap. This occurs when you refuse to sell a losing stock because you're emotionally attached to it or you feel the need to break even. However, holding on to a losing stock for the sake of recouping losses often locks your capital in a failing company, preventing you from moving on to better opportunities. Rather than holding on to a losing stock, consider cutting your losses and reallocating that capital into a more promising investment, such as a broad index fund or a recovering asset. In many cases, that money could be better utilized elsewhere, helping you build wealth rather than sinking further into a poor-performing investment. 8. Underestimating inflation erosion. Finally, conservative investors who stick strictly to bonds or safe savings accounts often underestimate the impact of inflation on their purchasing power. If your return is 4%, but inflation is 5%, you are guaranteed to lose wealth every year, regardless of how much you save. While bonds and savings accounts are low risk, they're also low return, and they can't keep up with the rising cost of living. To protect yourself from inflation, consider investing in assets that outpace inflation, such as stocks, real estate, or inflation-protected securities. These investments tend to offer higher returns, which can help you maintain your purchasing power over time. Make sure your portfolio includes assets that are designed to keep up with inflation, so your wealth isn't eroded by rising prices. There you have it. These are the top 8 investment mistakes that could be costing you thousands of dollars without you even realizing it. By avoiding these common traps, like cash drag, high expense ratios, and chasing trends, you'll be able to make smarter decisions with your money and grow your wealth more efficiently. Remember, investing wisely requires patience, discipline, and a focus on the long term. Start making these changes today and watch your investment returns soar. Thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe for more insightful financial tips. Drop a comment below with your thoughts on these investment mistakes. Have you made any of these? Or do you have tips to share? Until next time, keep investing and growing your wealth.